It's been 2 months since the federal regulators who regulate mortgage lending have allowed a secondary form of credit scoring to be used to help home buyers qualify for mortgage financing. We all have known and have used FICO for the past 3 decades. Now, there's an alternative called Vantage. Well, is there an advantage to Vantage? What's the real world been like these past 2 months? What is happening for the benefit of the home buyer? And, well, what's not happening? On today's episode, I'm bringing in my friend, my colleague, a badass mortgage professional who also goes by the name Credit Kristi, to talk about Vantage credit scoring versus FICO credit scoring and how this industry, the mortgage industry, is working to benefit more home buyers, bring more value to real estate agents. If you're a realtor, if you're a home buyer, if you're in the mortgage industry, well, this episode's for you. Check this out. They don't teach this shit in school, but they should. Welcome to the Loan Officer Podcast, hosted by me, Dustin Owen, one of the most influential people in the mortgage industry, along with my friends who've lived it, built it, failed at it, fixed it, and scaled it. This is not a show just for mortgage professionals. This is everything I learned because I became a mortgage loan originator. This is the Loan Officer Podcast. Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to Loan Officer Podcast with me, Dustin Owen, and a very special guest. Back for, I think, the 3rd time. She is my friend. She is a colleague. She coaches at T-Lob's Originator Coaching. She just opened her own mortgage brokerage while also enrolling back into school so she can become Dr. Kristi and not just Coach Kristi or Credit Kristi. She's going to be Dr. Kristi. She's an amazing human being. She lives here in Orlando, Florida, right down the road from me. She's the one, the only, soon-to-be doctor, but currently just Coach, Kristi Nowrouzi. Kristi, welcome back.
Hey, thanks, Dio. This is awesome.
This is super awesome. So we have a lot to get caught up on. Open your own brokerage.
Yep.
Okay. And we were talking off camera about this. You have a partner.
Yes.
Right? So you and a partner now own your own brokerage. Mm-hmm. That's freaking amazing.
Yeah, it's awesome.
How's it been?
Feels great. Yes.
It feels great. What's one thing that has gone extremely well and one thing you're like, crap, I overlooked that?
Let's start with the crap.
Okay.
That came to mind first. LOS is really important. And so the origination system that we're working through with a small contract is not one that's preferred. So that actually really, really makes a difference. Time consumption.
Yeah.
Right?
So when you are an originator,
yes,
an originator only, you're typically not worried about which LOS are we going to use and what do you mean there's a contract and what do you mean there's a cost difference or a cost savings?
Yeah.
So your oh crap moment is, wait a minute, I just want to help people and do loans.
And November can't come fast enough.
Okay.
So there's that. And then what's gone extremely well is just the acceptance, the excitement around it, the support that I've gotten from my community has been really cool.
Yeah, because is this brokerage tied into a particular real estate office? Or?
It is, yeah. So the relationships there are very, very deep. It's been ongoing for a lot of years, and now it's even deeper. So
that's so awesome. Well, congratulations.
Thank you.
Who has to do the mortgage call reports? Is that something you have to do or something they do?
Thank you, Lord. I don't have to.
Yeah,
not it.
Yeah, not exactly. That's always the thing on my end. I'm like, man, if I were to ever get roped into
a compliance manager or an operations manager that takes care of that.
Yeah, I want to
do
market.
What you do best. That's
I want to market. I want to network. I want to sell, give advice. I really don't want to sit down and do a bunch of compliance paperwork.
Yeah, not for me.
Very cool. I talked about this. Soon may be relative, 3 to 4 years from now.
Yeah, a couple years from now.
But you have enrolled back in school to get your PhD.
That's one of the most extraordinary things about being in this industry is that allows you the flexibility to do what you need to do or say yes to what you want to for your business. And I appreciate this industry so much for that. And I am a lifelong learner. So I have started back in school. I've started my PhD program.
And what are you going to get your PhD in?
Social psychology.
Okay. What do you want to do with that? Are you going to continue to do loans and consult
I think
borrowers
so.
and realtors?
I think so.
Okay.
But as you know, one of my favorite things to do is to teach. And when I'm teaching, usually from a stage or from some type of presentation model, I love having as much information that I can bring to others. And this helps. I am learning, it's not clinical, it's the research side. So I'll be learning to do studies and gather research and be able to present it in a way that makes sense to other people. So I think it'll tie in beautifully.
Well, and you were just tapped on the shoulder to speak at NAR?
I am
like
speaking.
the NAR, like
Yes.
the big conference.
Yes, at their annual conference in November.
Wow, where's that going to be?
New Orleans.
Okay, what's your topic? Do you know yet?
Yes, it's on quickly developing trust.
How to quickly develop trust.
Yes.
So you're teaching a group of realtors so that they can build trust quickly with a potential seller or potential buyer.
Well, even before your very first introduction, before your first meeting, people are looking at you. They're looking at you online. If you're having a conversation, here's a quick thing. Most of us, when we say hello or answer the phone, however we answer, it's with us breathing in a way that actually signifies a reduction in confidence. And so there's a lot of non-communication cues. There's a lot of things that you can do ahead of time to be able to establish trust even before your listing presentation or buyer's consultation. So we're talking about how to identify and then speak to the behavioral style that your client is, how to find that out even before you have a consultation.
I love this for you. I mean, I love it for them too, that they get to learn from you.
Thank you.
Things that people probably don't know. You're a 3 times published author. You're a Toastmaster.
I am.
Right? You were able to give a TED Talk?
I am, and I've been invited to come back. I'm a curator, which means I get to go through the applications and select the TED speakers.
That's super
It's
cool.
extraordinary. And then coach them through it up to their talk.
Yeah, and obviously because Kristi is Coach Kristi here at TLOP's Originator Coaching, she will be on the TLOP Unite Caribbean Takeover event.
I can't wait for that. This is going to be such an extraordinary time. We're going to have amazing connections, relationships that will probably go on for many, many years
For
after
decades,
this.
yes.
We're going to have some education breakouts. We've got incredible sponsors that are going to pour into us. I'm giving a presentation. I know the other coaches are giving presentations. It's going to be so much fun. And then let's not forget about all of the fun elements of a cruise.
Well, correct. We've talked about the pool, the jacuzzi, the shows, the bars, potentially the casino.
All of it.
Yeah.
All of it.
And it's super affordable.
Oh my
super affordable.
Gosh, insane.
So I'm hoping that the same presentation you are going to give to realtors at NAR, that may work for everyone that's coming on our event. Would you be willing to give it to them? Kind of.
That would be great.
They'll get to preview it, honestly.
It will, because that's
before
in
the
September.
realtors get to do it.
Absolutely.
Yeah,
this is the most extraordinary sales industry ever, is helping somebody with their largest financial decision, right? It will twist really well.
Yeah, of course there's me who has to put the fun into anything. So I'm thinking, okay, we're going to do this one-day sales summit at sea. And then we have you, we have Coach Brian, we have Coach Gwen. Right, all three with your big personalities, all three super successful in mortgage, but you've gone about it 80% the same way, than 20% with your own kind of unique flair. But all three of you are fair-skinned with light hair that is more on the red side or orange side, right?
You're going someplace with this.
Yes, ready? So I'm thinking that we run you, Coach Gwen, and Coach Brian back to back to back, and we're just going to label that Gingers Do It Better. So like that part of the sales summit at sea is going to be our Gingers Do It Better. And we'll dedicate an hour and a half to that.
I love it.
And maybe we'll run that right up until we do the, we'll break for lunch. We'll come back. JC and I are going to do a podcast live in front of the entire audience before we maybe kick it over to some of our other keynote presenters of the day.
Awesome.
Well, let's do this. Let's jump into why people actually came today. And they came to learn more about the differences between FICO and Vantage, what we're seeing, what we're experiencing, what we're hearing from our friends in the industry. Mm-hmm. And also for the realtors and the home buyers, what they need to know, because I think there's some missed opportunities. I think there's some people who were told no last year that should be told yes. I think there's some people who maybe found that home ownership was going to be not as affordable as they were looking for, but maybe with Vantage, it has become affordable. Yep. Yet maybe realtors and loan officers are not using this as an opportunity to reach back out and reconnect. So that's what we're going to get into. But first, we're going to take a quick pause so that we can hear from today's show sponsor. Check this out. Y'all, something big is happening at Lower Mortgage. And if you're paying attention to this industry, you've probably noticed. In just the last month alone, Lower has added some serious horsepower. We're talking top producers representing over $350 million in volume. These aren't rookies kicking tires. These are heavy hitters who've done their homework and made the move. That should tell you something. On top of that, Lower just acquired Movoto, a top 5 real estate portal with over 150 visitors just last year. Before that, they brought in Neat Labs, and now they're launching Lower OS, a next-gen mortgage platform that's cutting loan delivery times down to 10 days. This isn't a company standing still. Lower doubled their volume last year, and they're projecting another 40 to 50% growth this year. The best in the business are taking notice, and they're voting with their feet. Here's the reality. The companies that are going to win in this market are the ones investing in technology, building real infrastructure, and competing at scale. Lower is doing all of that. They're going head to head with the Rockets of the world, and they're built for originators, not against them. If you're a producer who wants to be a part of something that's actually going somewhere, not just surviving, but growing, this is the moment. Lower Mortgage, the momentum is real. All right, so we're back. We are back. The one thing that we didn't mention as well with you being a coach is, Kristi's leveling up in so many aspects. Ownership interest in your own brokerage, publishing your 3rd book, signing up for your PhD. But even within TLOP, you have been one of our first coaches. You show up several times a month to give back to our community. But you're now going to be graduating 100 students from our signature launch bootcamp between June of this year and June of next year.
I'm so excited.
With your first group kicks off in 2 weeks.
In 2 weeks.
Yeah. So it's my curriculum,
Yep.
right? It's the curriculum that I've curated over the past 15 years. It's the course I've been teaching for the past 3 years, and I'm going to continue to teach it. But right now I'm teaching it to companies like CMG and Mid-Florida Credit Union, and they're giving me 20, 30, 40 originators at a time, and I'm putting through them the same curriculum. You're going to be putting people through this curriculum following the 16-week boot camp that we've been doing. I'm stoked for you, but I'm stoked for them because, I found y'all as coaches, you do a lot of things way better than I do. Way better than I do. And I'm thinking about Ross and Scott and what they do with Elite. I already know Brian Kemble knocks it out of the park in terms of his elite coaching style. I can only imagine Gwen's is similar and Rebecca's is going to be amazing. But I know that you can take this curriculum and put your own emotional intelligence into it. Plus, I think you do a better job of holding people accountable than I do. And which that's like a weak spot of me. I'm like, you're a grown ass adult. You should show up and do your job. Yeah, where I think you'll be softer up front, but I think you're also going to hold their feet to the fire.
A punch and a kiss, right?
Yes.
Like a punch and a kiss.
Yeah, so I'm excited for that too. But let's get into Vantage.
Yes.
Yep. When Vantage rolled out, how would you best describe this to a real estate agent or to a home buyer?
So Vantage, when it first was introduced to the public, was really through Credit Karma. That was the biggest way that we could tap into it.
No way.
Right?
Oh, so all those years when someone said to me, I don't know why you said my credit score is 680. Credit Karma says it's 740.
Right. And
I was 8 years old when I put 2 and 2 together.
Yeah, right.
Okay.
So Credit Karma brings in 2 of the 3 bureaus, but from a different, and there's literally dozens of scoring models out there. We know a handful of them, but there's dozens of them. And so when a consumer is looking at their credit score, they're typically looking at, let's say, their Credit Karma. And it's funny because I've seen both sides of the coin. I've seen it where somebody says, oh, my Credit Karma says I have a 680. I've pulled credit, and we were in the 700s.
Oh, cha-ching.
Uh-huh.
Yeah.
Yes, even better. And I've also seen where I've got a 680 and I pull and they've got a 560. I'm like, what's happened here, right? So it's very different. VantageScore has a whole different approach to how they view credit than what FICO does for the lender side, which has been what has been the default for lenders for 30 years.
30 years. And it is argued that some of that algorithm is outdated.
It absolutely is.
Consumer behavior has changed, yet the algorithm that was coded 30 years ago hasn't kept up with the times.
Fully 100% true. Very, very antiquated. And what ticks me off the most is like collections. On the FICO level, it appears that whether you have a $10 collection or a $10,000 collection, the hit is the hit. Whether it's a medical or a mismanagement of money, it hits the same.
Yeah, so it's like on the FICO model, if I shoplift a pack of gum, I'm going to be penalized the way that a murderer would be penalized. It's like, nope, you're both being locked away 30 to life. I'm like, but I just stole a pack of gum, and this lady killed her husband.
Correct.
And we're both getting 30 years.
A repossession of a car should probably be a little weightier.
Yes. Than a medical collection
because your kid got sick at had to go to the emergency room.
Or better yet, let's say medical collections all fit because there's someone tuning in saying, well, medical collections, have been reprieved in terms of we don't have to pay them off, but they still impact our score.
They do.
But it's no different than I didn't turn in my cable box when I moved from this apartment to this house. And all of a sudden, there's a $79 Spectrum collection on my credit. I'm like, what? And look, my wife thought she did it. I thought I did it. Really, it's in a box in the storage unit that we just have to go dig up.
I just moved, and it took months to finally feel settled. You absolutely oversee those things.
Yeah.
Mail sometimes doesn't get forwarded. That box got shoved in the garage with everything else, and 3 months later you go, oh no.
Yeah, and I have a collection.
And now I have a collection.
So you're saying FICO doesn't differentiate.
Destroys you for the smallest things, where Vantage will give a different perspective. And so let's say you're somebody who's just starting credit.
Yes.
And you're new to it, right? You're in college or something along those lines.
In your 20s, you're new to this country. Maybe you grew up in a more rural area. Like this is where we're seeing people who have the term we use is thin credit.
Correct.
It's not that you have bad credit. It's just like you just don't have a lot of credit. Heck, maybe you were introduced to Dave Ramsey when you were 20 years old.
And
Dave Ramsey was like, if you can't pay cash for it, you don't get it. And it's like, cool, you have no debt, but you also have no credit.
And you also get punished for that as well.
Yes.
If you go to apply for a mortgage, for instance. And so VantageScore will calculate your credit algorithm within a month of having a credit card open, where FICO requires a longer runway, typically at least 6 months.
Yes.
And if you're in a hurry, if you're wanting to buy a house like this summer, you don't have 6 months, but you could manage 1 month. And so Vantage just looks at things a little bit differently. Vantage will also have the perspective of your trended behaviors. So let's say you had a big charge on a credit card, but you've been paying it down instead of just maintaining that balance. It's going to be reflective in your score on Vantage, where FICO doesn't look at it that way. FICO just looks at your debt utilization. In other words, if you're greater than 30% of what's allotted to you on a credit card, they're going to slap you around with that. Vantage is saying, hey, look, they went and bought this big thing and they're paying it down at a faster pace than, say, their minimum payment. Kudos to you. I'm gonna help you with your score here.
Yeah, and that's really where things sit. The advocates have seen this. The advocates for Vantage are like, look, this is not right. There are people out there that are good quality people who we anticipate to have stable employment and be able to pay their bills. Right. Where FICO may have been punitive, Vantage isn't, especially because of the trended. So here's
now.
Okay. Yeah, so now, like, do you want to jump into it or
no? Go.
No. So it's like, so now here we are. We're recording this in June 2026. It'll air June 2026. So April of 2026 is when we are lenders, we're able to, for the first time, to be willing to use a Vantage credit score instead of a FICO.
Right.
And it's been enough time has passed where I think we have enough data to talk about it so that our community, the loan originators, the company operators, the real estate agents, the home buyers, even the financial advisors and the insurance agents who all tune in to this show, like, we can tell you, because we're boots on the ground, this is what we're seeing, this is what we're hearing.
Yep.
And I probably talked about this on a previous episode, because anyone who knows anything about this industry could have predicted what was going to happen have happened. This type of change is not an easy change. This type of change is something that doesn't happen overnight. And it's because you have to understand there's an entire industry in a world that transpires after a loan closes, right? It's not like we're in Canada or we're in Europe where a loan closes and that loan's owned by that bank. No, a loan closes and then that loan gets securitized and packaged and turned into a security, such as a mortgage-backed security or a bond. And I think when people can wrap their heads around that, you're like, okay, so then why could I not just snap my fingers and say, I'm using Vantage? And it's like, well, because we don't know if the end user in the mortgage industry, the end user is the guy or the girl, the company buying that bond. We don't know how they're going to put a value on that package of bonds because there's no data on how these loans will perform.
That's the key right there.
Yeah.
Until we have evidence of payback history, risk tolerance, those kinds of things, we're just hoping for the best.
Yeah, it's quite possible that a package of loans that are all scored using Vantage outperforms
Wouldn't that be awesome?
FICO.
Yeah.
But we won't know that
don't
for
know that
2,
yet.
3, or even 5 years.
Right.
And then we have things like this. A lot of us rely on mortgage insurance companies to allow us to do low down payment loans, right? 3%, 5%, 10% down. Conventional financing requires mortgage insurance. Well, mortgage insurance, for those that don't know, it just protects the lender against someone going into default. Well, mortgage insurance, like any insurance, is risk-based pricing, right? If I've had a DUI and I drive a Corvette, I pay out of the nose for my car insurance. If my wife has been driving for 40 years and she's never had an accident and she drives her Acura MDX, she pays a lot less. Well, same thing applies when you're looking at a mortgage insurance company. And mortgage insurance companies are like, they're kind of like 6-7ing this whole like, okay, you're showing me a 710 Vantage score, but how do I price that? Like, is that good? Is that bad? Is it a medium? Like, where do we sit?
Right.
So I think there's a lot of uncertainty happening, and then we're experiencing this. I'll ask you the question. How many of your friends in the industry do you think work for places that are allowing them to use Vantage?
Well, that was my next thought. So just because this is rolled out from the regulatory agencies doesn't mean that all of the lenders have accepted it. It reminds me of a conversation I just had 2 days ago with somebody who's got a 600 credit score. And when I was explaining to the agent that we're going to go FHA, they were like, well, I read
Yes.
that conventional loans no longer have a minimum credit score.
And
I'm
that
like,
is
"You're
true.
absolutely right. And we're doing minimal down payment. So let me show you what's going to happen with that interest rate and with the mortgage insurance, to tap on what you were just saying. If we've got a 600 credit score, they're priced out. It's priced out. FHA is the way to go. And they just needed that explanation. A similar thought here with, even though the agencies have said, hey, let's go, let's roll this out, not all lenders are doing it. So you've got all different types. You've got direct lenders and banks, you've got the correspondents, you've got brokers, you've got all of these different perspectives, and not all of the lenders are on board.
Yeah, and not all the lenders are on board. It's not one reason.
Right.
I mean, the first reason is a lender's only going to go on board if they know they can deliver that loan
Yes.
into the secondary market, right? We as lenders make widgets and we sell those widgets to people who want to buy widgets.
And if they have to hold it, it costs the company money.
Yes, so I'm only going to make something that I can sell. And then on top of that, I rely on mortgage insurance companies. Yeah. Well, if a mortgage insurance company won't insure it, or if the insurance on that loan is so expensive, then it becomes prohibitive to even do the loan or offer the loan. And then how about this? We all rely on certain points of sale technologies. You talked about this earlier, loan origination software. What happens with my LOS? What happens with my POS? What happens with my pricing engine? Because now I'm basically asking my pricing engine to price me out. Well, price me if I used a FICO, price me if I used a Vantage. And it's become a little bit cumbersome. And on top of that, I don't believe that the FHFA is allowing every lender to participate. Now, like, I know UWM's participating. Yeah. I believe Rocket's participating.
Some of the big dogs, yeah.
Like, I think even my old employer, Waterstone, may be participating, right? So there's definitely, companies out there participating, and there's definitely some that aren't. And there's rationale for those that aren't, and we just explained what that rationale would be.
And the other thought, too, though, is if these big conglomerates are not paying for that credit pull up front, and the little mortgage companies are responsible for doing that, or the consumer, are we going to ask the consumer to pay 150 for each credit pull to find out if one is better than the other.
Yes.
So there's physically a cost involved too.
Yeah.
Yeah.
That has to be navigated. And I know, because I'm friends with the guys over at UWM, and I know they originally rolled it out to where I think every one of their clients didn't have to pay for the FICO or the Vantage. But my guess would be that would be a temporary thing in order to get some data, to get some interest in actually originating loans using Vantage. But then all of a sudden, I can't imagine that's a long-term play. Right. I think at some point, if I'm at UWM, I may look at some of my like more elite, more platinum clients that I'm getting a lot of volume from, and maybe for them I can still offer these incentives, but I can't make the incentives to everybody because they still have to run a profitable business.
And now that trigger leads are gone, you know that those credit reports are going to continue to increase in cost.
Yeah, but the goal with Vantage, like I haven't sat down with Bill Pulte Jr., the director of the FHFA, ever, but if I sat down with him, he was like, look, I wanted to expedite this, which he did. I mean, he had this thing rolled out with literally like, we're going to build this parachute as we jump out of the airplane because the industry wasn't ready for it, but screw it, rip off the Band-Aid, let's rock and roll. But I'm sure if you sat down and talked to him, he would say one of the underlying themes of Vantage was because credit reports have gone up 400 to 600% in the past 6 years, they had no competitor. So let's throw a competitor in there.
Yeah.
And then let's see if that can drive the prices down. However, you just made a point. But what if I have to pay for 2 credit reports?
Right.
Because how do I know which one's better without pulling them both? And I think if you're in the FHFA, you're probably sitting in a dark closet right now, twiddling your thumbs, being like, I guess I didn't think that one through fully. Let's talk about some of the positives that we're seeing, right? Like there's things that we're seeing positive with those that are using Vantage. And then there's obviously, things that aren't so positive. So the things that are not so positive right now is it's not widely available to all. Right? It's just not. It's select lenders are using it.
Right.
And select lenders, by the way, are also putting in their own guardrails. Right? So and each lender is going to be different. And by the time we record this, by the time it gets post-produced, by the time you listen or watch it, it's going to change 17 times.
Right.
So I'm not even going to try to get into specifics of what lender does what. If you all have an idea, use the comment section. Comment like crazy. Give us the real world experience of what you're seeing.
Yeah.
But I think it's good for the audience to know that just because a lender can doesn't mean they will.
TLOP Unite is not your typical mortgage event. This is the first ever TLOP cruise experience built exclusively for originators. And for 4 days, it's not about the speakers, it's about you. We're talking breakout strategy sessions, real conversations, curated events, and uninterrupted access to a community that helps you grow. If you're serious about taking your career to the next level, this is where you need to be. Space is limited and the price is right. So click the link now and learn more.
So a lender may say, hey, look, I'm only going to use Vantage if this person also qualified using FICO.
Right.
Okay.
Yes.
They may say, I'll only use Vantage, but only on loans that don't require MI, mortgage insurance.
Right.
They may say, I'm only going to allow you to use Vantage, but if they have 6 months reserve, right? We call those overlays. In many instances, most of us work in organizations where we run full steam ahead with no overlays, right? Overlays are a thing that really transpired post 2008, 2009 crash. Well, I would tell you, expect overlays. If you are working for an institution or borrowing money from an institution where they're going to allow you to use Vantage, then expect overlays. You have any thoughts or experiences on that?
No, I think that it's experimental right now.
Yeah.
And so be prepared for things to shift very drastically. Just because they said yes to this today doesn't mean they're going to say yes to this tomorrow. It's almost like an overlay to me is like we get hurt. As people, we get hurt over time. And if somebody hurts you, you're going to say, I'm never going to, right? You got your own overlay.
Yes, yes.
Right? Like this emotional scar is your overlay.
Yeah.
So I think if a lender winds up getting burned, right? Like they go, oh, shoot, we had mortgage insurance and this mortgage insurance company said no to all of these Vantage scores. And now we have to self-insure or something. And so now we can't sell it off in the secondary market. We got burned.
Yes.
So to your point, those overlays may change over time and just be ready to pivot with it. So don't make any presumptions that just because it was like this on this day, it's going to be like that on that day. Hopefully it becomes better, easier, a lot more fun to play through. But
give us 24 months as an industry and we'll probably have this figured out.
Oh, first time in 3 decades. It's going to be a little bit of figuring out.
And here's some of the positives that that we're already seeing. Like we're seeing this ground floor happen, and it was. I'll give a shout out to Chris Parker over at United Wholesale. So Chris and I met him through the industry. I think he's an absolute stud, and he and I talk or text probably monthly.
Love it.
Okay. And Chris shoots me an email because UWM was one of the pioneers. I mean, when you are the number one wholesale lender in America,
there you go.
You're probably going to get first cracks and first access at a lot of things.
You should.
So yeah, they can run this at scale,
yes.
And they can also afford to do it.
Yes.
Like if I'm
beautiful test market.
Yes, if I'm packaging a security and there's 1,000 loans in the security, if I bury 5 Vantage loans in that, it doesn't skew or mess with what that security is worth. Right. And that's any bond, right? So any bond, you can, heck, any bill you can, like if you're talking about like legislation, you can slide some pork in there.
Yeah,
you
do
can
all the time.
Yes. Well, same thing works. If I have 995 loans that I have all the data on, and then I can use predictive analytics to tell you exactly how they're going to perform, I could easily slide 5 in there saying, hey, don't know how these are going to perform.
Let's find out.
But I'm gonna include them
right.
with the other 995, so it's not going to skew this to make it any more risky.
Right.
But I think what's good to know is even those 5 loans, they weren't bad loans. Like lenders are not in the business of doing bad loans.
Nope.
Okay, Wall Street's not in the business of buying loans that go into default. But lenders can look at a file. You and I can look at a file and say that person should qualify.
That absolutely makes
like
sense.
I would lend them my own money. And I think this is where Vantage, and this is where Vantage is coming into play. You have a 605 FICO, but you have a 645 Vantage. Well, what's the difference? Well, it's one of the scenarios that you just talked about. This person literally has a car payment that they've had for 12 months. They have their rent, and they have a credit card that has a $300 limit,
right?
And they probably put $300 a month on it. And they pay it off every month.
Yeah.
The problem is it shows as a maxed out credit card that they've maybe only had for a year and a half. They have that one auto loan they've had for a year, and they have their rent, and that's it. But there's no deficiencies, no judgments, no bankruptcies, no collections, there's
no evidence of I'm not good at managing my money.
Correct, none at all. But FICO just says, yeah, but there's not enough evidence that you've had enough time to be graded. And Vantage comes in and goes, I got enough. The trend of data tells me you're at least a 645. Well, a 645 is going to get an AUS approval, where a 605 is not.
Right.
And that's another thing. Right now, we can do manual underwritten loans. Right? You can do VAs, you can do FHAs, USDAs. You can even use conventional manual underwritten loans. However, I am hearing from a lot of my lender clients, they won't allow you to do a manual using Vantage. Right? So you're going to have to use a FICO score if you're doing a manual underwrite. Okay. If you're going to use Vantage, at least the people I've talked to, they're going to mandate that you have some kind of an AUS approval. So in that example, Vantage was 100% the way to go. The person has thin credit, but it's not bad credit.
Right.
But let's check this one out. And this came directly from Chris. So Chris, and I'm sure it was a humble brag, and he should be super proud of this. His company crushed it. FICO, 683. Right, that was the FICO score. Vantage, 765. Okay, this is a conventional loan for someone who probably has an extensive credit history. But however FICO does their scoring model and compare it to Vantage, one was clearly better. Now, this borrower qualified, truth be told, using both scores. Mm-hmm. Like they qualified using FICO. They also qualified using Vantage. We have the AUS to prove it.
Right.
But for my lender friends, they know this. Realtors and buyers, maybe not. We have things called LLPAs.
Loan level price adjustment.
Yes. How would you describe an LLPA to someone who doesn't know?
The easiest way is there's requirements that they look at. So if you're putting down a little bit less, you're a little bit riskier because you got a little less skin in the game, hence a slightly higher interest rate. If it's your an investment home versus your primary home, if you had to choose between making a payment on one versus the other, you're going to keep a roof over your own head. Yeah. So the investor is a little bit of a riskier move. So anything that has a little bit more risk involved, which is indicated through a lower credit score, you pay higher for borrowing that money.
Correct. So loan level pricing adjustments, we call them LLPAs. It is basically an extra fee that you pay, whether it's upfront at closing or it's buried into your rate, and sometimes both, right? Sometimes as a lender, we'll charge you a little bit more upfront, a little bit more in your monthly payment. Right. And that's how we solve for you having a 670 credit score and you're buying a condo versus you having a 780 credit score and you're buying a single family home. Because by the way, condos are deemed to be riskier collateral than a single family home. So therefore there's an LLPA hit to condos. So when I was talking to Chris about his scenario, when you look at a 683 versus a 765, it was 187 basis points in pricing.
Let's try to figure out what that translates into.
Oh, well, like on a $400,000 loan, you're looking at almost $8,000.
Annually?
No, up front.
Oh,
closing cost.
Up front.
Yeah,
okay.
Closing costs.
Okay.
Right.
And even the difference on the interest rate is going to cost you thousands each year.
So it was one of those things where, and no, maybe it was like 111 basis points difference. So So the way that this loan is being structured by this mortgage broker who's sending the loan to UWM, it was, if they use FICO, they would have to have charged 1.87% discount points
up front
instead of having to just charge 1.15. Okay, so that is a 75 basis point swing. Yeah. So yes, on that $400,000 loan, that was roughly $3,000.
Yeah.
Okay, so they saved $3,000 up front, but here's the kicker. They also, because of LLPAs, they were going to have a 7.5% rate instead of a 7% rate. Okay, and maybe this was a cash out refi on investment property. I don't know the particulars, right? It was very specific to the LLPAs, the upfront fees and the monthly payment. But it was like a $700 a month payment difference. Now, my friend Chris would love to have me run the math at that $700 times 360 payments. But you and I both know, Kristi, that borrower is not going to have this mortgage for 30 years. Right. But let's say they have this mortgage for 5 years. Yeah. That's still 6 months times 700. Oh my gosh. Right. So you're still talking about more than that. $42,000 difference. Yeah. Right. I mean, that's a huge dollar amount.
Huge.
So this right here, I think this is where Vantage comes into play. So now if I'm a loan originator and you and I were their coaches.
Yes.
Okay, the very first thing I'm saying is, oh my gosh, how many people over the past 18 months didn't buy?
Because they weren't comfortable with the payment.
Either they weren't comfortable with the payment or their credit score was sub 620, sub 600, whatever the case may be.
Pull that list.
Go to every real estate agent that you've ever worked with and say, hey, how many people did you talk to last year that wanted to buy a house, but they couldn't qualify for financing?
Yes.
I wonder if things have changed. Would you mind if me or my team and I texted, called them, emailed them, let them know about Vantage scoring? I wouldn't even say Vantage scoring. I would say things have changed recently in the mortgage industry that is making it easier. Yeah, if I tell them Vantage score, then I basically gave away my secret, and now they can take that to their brothers, sisters, cousins, aunt who also does loans.
You come to them with a solution. You can keep that solution, your secret sauce.
Yes. Yeah, but like that would be a tip that I'd be giving loan originators like right now.
After you make sure you have lenders that will participate.
Of course. Yes.
And what their overlays are.
Don't go sell something you don't have. Can you imagine that? I'm like, crap. Hey, I get 5 leads I have to give to my buddy down the street, or else I have to transition to a new company.
Right.
And who knows? Maybe you do want to transition, and that's
in MLS. I need to move my number.
Yeah. But that's when I throw it out there. Like, look, before you make a move, I actually offer a free service through TLOP. Like, it's called TLOP's Career Advisory. I talk to 5 to 6 people a day right now.
I love that you do that.
Well, think about this. You and I talk to borrowers every single day.
Yep.
1 in 7 actually do a loan with me, right? Or 1 in 5 do a loan with me. They don't all do a loan with me, but I help them all.
Yeah.
Now, some of them I help in 3 minutes, some I help in 3 weeks, but it's what we've always done. If you're a loan originator or a branch manager out there and you have questions regarding your career, what I've learned is that I'm not going to ask my spouse because she has never worked in the mortgage industry. She did not go to school for business, and no part of what I do for a living excites her except for the paycheck. Okay? So, and even that, I think the paycheck excites me more than it excites her.
If you're a licensed originator who's closing loans, but you're not consistent, this is for you. If you're brand new or just looking for motivation, trust me, this is not for you. Most LOs don't need more information. They need structure. They need proven processes and somebody to hold them accountable. T-Lob's Originator Coaching gives you weekly live coaching, scripts top producers actually use, and step-by-step business systems you can implement immediately. Not someday, we're talking day one. You're not watching videos alone. You're executing in real time with other originators who take this seriously. Right now, you can try it free for 2 weeks. That's 2 full weeks for free. You'll sit in on live coaching calls. You'll get access to the frameworks and see exactly how top producers run their business. If it creates clarity, if it creates momentum, or even if it puts wins on the board, you keep going. If it doesn't, no worries, you can cancel. No pressure at all. Click the link, start the 2-week trial, and finally, build this like a business, not a side hustle.
So I'm not going to go to my spouse, and there's certain things I'm not going to go to my manager about.
Right.
So yeah, T-Lob's Career Advisory. Like we have a link, but I just tell people, go to my LinkedIn, first name Dustin, last name Owen, send me a message. And I promise you, I'm easily accessible, but I will spend 15 minutes with you, bounce ideas, mastermind, leverage my experience.
So good.
Yeah. So on your end, you were saying that they need to be reaching out to their entire circle of influence, their sphere?
This is a new opportunity that has been untapped, basically, for anybody working in the mortgage industry. If you were working in it 30 years ago, everything's been revised, hasn't it? But this is new for all of us. So we all get to figure it out together. But what a service to be able to provide to your partners, your referral partners, and your buyers, your borrowers, even somebody maybe for refinances. If the lenders are allowing you to use that for refinances, a lot of people have hundreds of thousands of dollars in equity, and they don't want to touch that 3%. However, they need to for quality of life. They're drowning in consumer debt. Whatever else is going on in their life, you might be able to save them a ton of money by using this new scoring model.
Oh my God, you just gave me the best idea.
Let's go.
Okay, so we already should be mining for refis.
Yes.
But we mine for refis thinking about tapping out equity, lowering someone's payment. What if you could lower their payment, but only because the refi you're going to use Vantage and the purchase you did last year or 2 years ago was a FICO?
Right.
How many of those people are sitting in your database that you should be mining right now?
And 2 years ago, they were likely close to, if not 7.
Yes. Yeah, but like, what if rates are exactly where they were today, 18 months ago, but the only thing that changed is 18 months ago, they were a 690. Today, they're a 780.
Wow.
And all of a sudden, there's a massive pricing differential for their benefit. And it's all because you can use Vantage today versus FICO.
Incredible.
But as Kristi said, make sure you can actually do it. And if you can't, that's when I'm like, how did I go to that rabbit hole of talking about career advisory? It's because you said something about people leaving. Yep. And I'm a firm believer that the grass is usually greenest where you water it, but also there are times when you're like, hey, this isn't working out any longer the way it used to. I need to make a move. Yeah. And I always tell people, before you make a move, check in with us first, because I can at least be a sounding board for you.
Yeah, you've got the info too.
What's that? Yes.
Yeah, you got the 411, so you'd be a great...
Look, I've made my entire career over knowing the most people, being the most connected. So yes, I do pride myself that there are definitely times when I can connect someone.
Yeah, you're in the know though, so you would be able to probably quickly determine what somebody's needs might be and who might be able to...
Just like you can with borrowers.
Yeah.
Like you talk to a borrower for 3 minutes, you probably have 80% of them already figured out.
Yes.
Right? Because you're like, I do this for a living. I've been doing this for a decade. Like a decade straight. I can probably answer the question before you even ask it because I know what's coming next. Well, thank you so much for obviously for coming on and doing this. I would ask what's next, but I know what's next. Like you have your first ever launch bootcamp.
I am so excited about this.
Yeah, so for those that don't know, launch is for anyone looking to launch their career, someone who is maybe bouncing back after a down year, or someone who needs to level up. And they're typically people who are not already funding 4 to 5 loans a month. There's a lot of people who are newly licensed, 6 months to 24 months, but I've had plenty of students that have been in the industry 13 years, 20 years, And they're like, look, I kind of feel like I'm in a rut. I kind of feel like I'm stuck. Or I feel like I have basically repeated year one 7 times in a row.
That happens.
And I need something that is going to be accountability, instructor-led, reading assignments, homework assignments with some one-on-one attention. And I'm like, yeah, it's called the Launch Bootcamp. And what's really cool is Kristi is going to have classes starting every 6 weeks. We actually have one starting in 2 weeks. Mm-hmm. We have one spot left. At least last I checked. We had one spot left.
Super.
And that one spot actually comes with the cruise. It's a 2-for-1. It's a 2-for-1. So you can do the 16-week boot camp. Kristi's your instructor, and you'll get a cabin for 2 on the TLOP Unite Caribbean Takeover sales event happening in September.
And what's the name of that ship?
Utopia of the Seas.
Oh my gosh, check that out, because it's an
huge.
Extraordinary ship.
It is one of their newer boats. It's one of the biggest boats. I'm excited because it has a country bar in it.
Let's go.
Yeah, and it has like an outdoor like water show. Like at the back of the boat is like this massive outdoor amphitheater.
Yes.
With like this massive water show.
Oh, I've checked it out.
Yeah.
And
I mean,
can't wait.
And I kind of like casinos. And there's gonna be a casino on that as well.
Of course there is.
But then we'll do our breakouts and we'll do our masterminds, and we're trying to podcast from Nassau, Bahamas. Like oh yeah,
you'll be an international. Well, you already are an international speaker.
Yeah, I've not spoken internationally yet.
Couple months.
I mean, our show gets broadcast internationally.
Yes,
we definitely have listeners throughout, definitely in Canada and Australia. So shout out to all of our Canadian and Australian viewers and listeners. But yeah, no, we're gonna have like a tiki bar. And do y'all remember what's the Bohemian beer? What's it called? Kalik.
Oh,
so
Kalik.
We're even trying to arrange it to where we can have like a live studio audience at this tiki bar, and it's unlimited Kalik while we're podcasting. How cool would that be? Yeah. So those are some of the things that we're going to do. Like we have to do our sales summit at sea. That's one day.
Yeah.
Right. We're going to do the private beach bash. We're going to do the sunset sail away mixer. We're going to do a huge party the last night, like the Bon Voyage bash.
Yeah.
But then we're going to have sprinkled in mastermind sessions and breakout sessions.
Love it.
Where, it's probably small groups, 8 to probably 18 people, 45 minutes instructor led. Some of the instructors will be coaches like you. Some of the instructors may be some of our sponsors. Mm-hmm. But yeah, super excited. Kristi, if people want to follow you, what's your preferred way of getting a hold of you?
I'm on all the socials. I'm on TikTok and Instagram and LinkedIn and Facebook. It's either Credit Kristi or Kristi Nowrouzi. I've got a couple podcasts out there, a couple books on Amazon. You can find me.
Yep. Spell Nowrouzi for us.
Nowrouzi.
And it's Kristi with a K.
Yes.
Awesome. Y'all, thank you so much for coming to hang out with us. She's Coach, soon to be Dr. Credit Kristi. Kristi Nowrouzi, my friend, my colleague, just an amazing human being. I'm Dustin Owen, the creator and host of the Launcher Podcast. We thank you for stopping by. If you haven't done so already, make sure you subscribe to the YouTube channel. Make sure you give us 5-star reviews on Apple and on Spotify. And remember, sharing is caring. That's all the time we have for you today, but we do look forward to catching you on the next episode. Peace.